When you're in business, it can be an exciting day when brand spanking new equipment arrives. But what happens years down the road when that formerly new equipment wears out and you either sell it, trade it in, or scrap it? If you sell it, do you have to report the income? And if you scrap it, can you use a loss to offset other income? I'm the Tax Geek, and today I'm going to show you what happens if you sell or dispose of a business use asset, oversimplified. This is not the first time I've made a video on this subject. In a previous video, we took a look at the tax consequences of selling business use real property, principally rental property. There's a link to that video above or in the video description. This video looks at the tax situation surrounding the sale or disposition of tangible, business use assets that are not real property. Business assets can be disposed of in a number of ways. They can be sold, they can be scrapped or discarded, or they can be traded in toward the purchase of another asset. These are the types of dispositions that you, as a business owner, choose to make. Business assets are also disposed of when a piece of property is stolen, destroyed, or damaged as a result of a casualty, when property is repossessed or foreclosed upon, or when a piece of property is condemned and taken for public use. These dispositions are known as involuntary conversions and will be the subject of other videos. Business use property is defined by Section 1245 of the Internal Revenue Code. Tax treatment of the sale or disposition of business use property is governed by Section 1231 of the Internal Revenue Code. Overall, the rule is this. Gain or loss on the disposition of a business use asset is calculated by subtracting the item's adjusted basis from the selling price. Just as a reminder, the adjusted basis of a business use asset is the original cost of the asset less any depreciation you took or could have taken on the asset. For a Section 1245 asset, the sale proceeds up to the adjusted basis is not taxable income. Any additional proceeds up to the original cost of the asset is considered to be depreciation recapture and is taxed as ordinary income. If the proceeds of the sale exceeds the asset's original unadjusted cost, any gain over and above the asset's original cost is taxed at capital gains rates. Rarely is any business asset other than real property sold for more than its original purchase price. If the asset is sold or disposed of for less than its adjusted basis, a loss is created that may be used to offset other income. Let's start with something easy. If you expense the cost of a business asset under the de minimis election, claim special depreciation or a Section 179 for the entire cost of the asset, or sell an asset after the recovery period of the asset has passed and all the depreciation has been taken, the entire selling price of the asset is a gain that is taxed as ordinary income. Let's look at Alice and Ralph's Bakery from the original video on makers. If you haven't watched that video, you might want to do that now. In 2021, Alice and Ralph purchased a commercial oven to use in their business for $4,369. By 2024, the oven was too small for their growing business, so Alice and Ralph decided to sell their oven and purchase a new one. If Alice and Ralph had taken either 100% special depreciation or the Section 179 deduction on the oven, any money they received for it, up to its original cost, is considered ordinary income. But since Alice and Ralph depreciated the oven using makers, any gain or loss is determined by subtracting the oven's adjusted basis from the amount they sold it for. So let's figure that out. The oven is depreciated using makers over a 7-year recovery period, so we apply the depreciation percentages from the makers depreciation table to each year of ownership. In 2021, they took $624 in depreciation, then $1,070 in 2022, and $764 in 2023. Since the oven is being sold in 2024, we take 1/2 of what would have been that year's depreciation of $545 or $273. Add the year's depreciation together and subtract the total from the original cost of the oven gives us an adjusted basis of $1,638. So if Alice and Ralph sold the oven for $2,000, they would realize a $362 gain, which would be reported as ordinary income. If they could have only gotten $1,000 for the oven, they would have a $638 loss they could use to offset other income. If Alice and Ralph traded in their oven and received a $2,500 trade-in allowance, that allowance would be the selling price of the oven, giving them a taxable gain of $862. The trade-in allowance, plus any cash they paid to purchase the new oven, becomes the depreciable basis of the new oven. As illustrated by these examples, selling or disposing of an asset for more than its adjusted basis results in some sort of taxable gain, even if the asset is sold for less than its original cost. Sales or other dispositions of business assets are reported on Form 4797. How Alice and Ralph report the sale of the oven depends on the circumstances. If the cost of the asset had been expensed under the de minimis election, the sale is reported in Part 2 of the form. If the oven had been sold at a gain, the transaction is reported in Part 3 of the form. And if the oven had been sold at a loss, the transaction is reported in Part 1 of the form. Gains and losses reported on Form 4797 are carried to Line 4 of Schedule 1 and subsequently to Line 8 of Form 1040. Since Alice and Ralph are partners, there are some intervening steps involving their partnership return, but the ultimate result is the same. This video is just the first in a series of videos on the disposition of business assets, and only barely scratches the surface of the subject. To learn more, check out the links to additional resources and information in the video description. If you found this video informative, please give it a thumbs up and share it with anyone who would find it useful. Subscribing to the channel and clicking the bell gives you immediate access to new Tax Geek videos. And your questions, comments, and suggestions are always welcome in the comment space below. Thanks for watching, and I'll be back soon with more of your taxes oversimplified.